With all the noise and uncertainty around SOFI, what is a fair valuation for this company, considering that it has seen some fundamental changes in its business? And therefore, in this video, we aim to play out different but likely scenarios that could affect SOFI's valuation in the years ahead. But I think more importantly, to answer the question on every SOFI investor's mind, does this company really truly have the potential to become not only either or, but both a one-stop shop financial services platform as well as the AWS of fintech, and how that is going to affect their valuation in the years ahead? But as always, potential is a dangerous word, so let's dive in. And so as we begin, I want to set the premise of this video. Right, see, the bulk of this video was actually prepared before I had the chance to listen to Anthony Noto speak on JP Morgan's conference. And so after listening to that, I have actually tweaked some of the assumptions that we use in this video to fit what he has been telling us about the business. Now, however, it's important to remember that in this video, what we are specifically looking at is SOFI's valuation in 2025 and 2026. But however, if you listen to the entire conversation with JP Morgan, Anthony Noto has actually given us information that we need to project out SOFI's business beyond 2026. And that's why there's likely going to be a second part to this video. Now, how this is going to work, it's going to be slightly different from other valuation videos you have seen me done on SOFI previously. Now, the starting point for this entire video is actually SOFI's management's very own words. Anthony Noto actually reiterated this during his interview with JP Morgan, that SOFI plans to operate their entire business at a 30% incremental EBITDA margins. It has also been known for a while now that SOFI are working towards a 20% net income margin. Now, I have actually previously explained how incremental margins work, and for those of you who are new to this concept of incremental margins or new to SOFI as an entire business, I'm going to link that video over here for you. But very simply put, for now, all you need to know is that incremental margins simply refer to the percentage of profit earned on any new amount of revenue that is brought in this year compared to last year. And so what we're going to be doing is to take these incremental margin projections and compare it against certain fundamental business metrics of the company, things like member growth, things like products per member and revenue per product, to understand what are the underlying milestones that SOFI needs to achieve, and that as investors we can keep track of to know that SOFI is actually on track to achieve their guidance. Now, moving into 2025, our assumption is that SOFI is going to be continuing to drive revenue growth in the year ahead. This is something that they have told us in their previous earnings call, and they're not going to be focusing so much on profitability in 2025. However, they're still going to be operating at a certain minimum level, and that has been actually defined for us in Q1 of 2025. Because if you take a look at the numbers that they actually produced in Q1 of 2025, incremental EBITDA margins came in at 34% and incremental net income margins came in at around 22%. So therefore, I assume that we are going to be seeing numbers more or less in this range for the rest of 2025. And what you actually notice over here is that you get an EPS estimate of around 32 cents in 2025 if you actually use these incremental margins and play it out for the rest of the year, which is comfortably above their current high-end estimate of 28 cents. Now, moving into 2026, this is where it starts to get a little bit tricky, right? SOFI has all along guided for a 55 to 80 cents EPS in 2026. And if you're familiar with the company, you would know by now, considering the way that SOFI run their business, what they tend to do is that they tend to just beat even the high-end estimate of their projections. However, during that interview with JP Morgan, Anthony Noto actually said something that was a little bit confusing to me, right? He actually told the interviewer, if we are going to be chasing growth in 2026, then he expects SOFI to only beat the low end of their EPS target of 55 cents, and it's only in a low growth environment, if they are focusing on profitability, should they be expected to beat that 80 cent mark. And so for me, when I heard this, it was a little bit concerning. It was also a little bit confusing, because the message is not really synergistic with what we have heard in previous earnings call. So to me, when I listen to it, I think the first thing that comes to mind is that he's actually sandbagging his own sandbag, and it really doesn't do anyone any good. And I'll leave this to discuss in a bit more detail in the second video. However, for now, if you just take his words at face value and you just look at the historical numbers, how they have been running SOFI's business. Now, historically, incremental margins in terms of EBITDA as well as net income has been in the 40 to 50% range. I'm going to show you the data over here across the last 2 years. And so what you actually realize is that in 2026, if you were to run the business at a 35% incremental EBITDA margins and 35% net income margins, I think what you get is that a full year EPS will come in in at around 57 cents in 2026. And so, this is really just beating the low end of their EPS guidance, which is not something I expect them to do, and it's not something they have done previously. So what I'm going to do is to, at the very least, project out to the midpoint of their guidance. And to get there, what we actually need to use is a 45% incremental EBITDA margins, as well as 45% incremental net income margins. Now, using this number, we get to a full year 2026 EPS target of around 66 cents. Therefore, from here, we'll be working backwards to see what sort of metrics SOFI needs to achieve in order to reach their EPS targets of around 32 cents in 2025 based on their incremental margin projections, as well as 66 cents in 2026. And understanding where SOFI is currently today as a business compared to where they need to go, we can make that determination whether or not that is actually a step too far. Now, apart from this, I think one of the things that we do need to account for is the multiple that we apply to SOFI's earnings. You see, the fact of the matter is that the tech platform revenue for SOFI will only see a more significant reacceleration in Q1 of 2026. Now, Anthony Noto specifically said this during that JP Morgan conference, right? Which means that when it comes to applying some sort of multiple on SOFI's earnings, they will not get any premium for having their tech platform. And so that means moving forward in 2025 as well as 2026, we should only assume that they should be trading more or less in line with other fintech, and they will not receive a premium above other fintech for their tech platform, despite the narrative that they have been painting about the AWS of fintech. And we can only apply a tech multiple on SOFI's earnings beyond 2026, depending on how the tech platform actually plays out. And so let's talk about the core fundamental business metrics. And let's start with our assumption in terms of SOFI's member growth. Now, in Q1 of 2025, SOFI actually added around 802,000 new members onto their platform and 789,000 net new members. This means after accounting for the removal of inactive accounts. Now, this represented a 34% year-over-year growth, and we know that SOFI is aiming to grow their member count at above 30% year-over-year. However, they are actually still maintaining, right, that their guidance for member for the full year of 2025 to come in at only 2.8 million new members. And I think this is where SOFI really frustrates me with their communication, because I think it's confusing to actually go on your earnings call, deliver 789,000 net new members and still guide for 2.8 million new members, and then you go on JP Morgan's interview and say that you hope to reach 50 million members by 2030. Even if I were to discount that and say 40 million new members by 2030, we need to be growing at a much faster pace. So to me, there's a lack of synergy. There's a little bit of a disconnect in terms of what they are telling investors during the earnings call, and then with all these separate interviews that we are hearing. So this is what, to me, makes it hard for people to project out the growth of this company, and it gives people the ammunition they need to continue being bearish. But again, this is something I'll talk more about in my next video. But if you take a look at the projections, the net new members are expected, at least for me, to grow at 33% year over year for the rest of the year. And going into 2026, bear in mind that SOFI aims to keep the growth rate above 30% for the foreseeable future. So I don't think we see this slow down by too much, but I do think that in 2026 we see our first 1 million member added quarter, net new members, right? And if you have been following this company for some time, I think you will know by now that products per member has been a very important metric for the company. Now, this particular metric has been stagnant for a while as they continue to grow their member base at a very quick pace. And another reason for the stagnation in terms of products per member, I guess, has also to do slightly with the removal of their crypto offering previously as they got their banking charter. However, as per management's comments, this is a year where they will continue to drive monetization of their existing member base, which means an increasing adoption of their products across existing members. And at the same time, if you consider what SOFI has been telling us about crypto coming back onto the platform, I think we should see this number climb at least in the back half of 2025 all the way into 2026. And if you listen to what Anthony Noto has said about crypto previously, SOFI plans to offer much more than what they were doing previously, where people could just buy and hold crypto. I think they hope to get into things like asset-backed lending through crypto. And if they're able to do this and to introduce new products to the market, I think they are able to drive up this product adoption across their existing member base. Now, so the next important metric, right, after member growth, after products per member, is that we're looking at revenue per product. And what I'm doing here is also slightly different because I want to point out the effect of the loan platform business. Now, I'm only going to be doing this for this particular valuation video to demonstrate the effect the loan platform business has on SOFI's valuation. But honestly, this actually adds another layer of assumption, which I don't really like to do. But just for this video, I'm going to be doing this, and let me explain why. Now, what I have done is to take the historical revenue for lending and financial services since Q3 of 2024. Now, combining them together, that is where I get my total lending and financial services revenue. Now, bear in mind that in Q3 of 2024, that was when the loan platform business was first introduced, and what I'm doing thereafter is to take away the revenue generated from the loan platform business. And what you are left with, this number that you are seeing over here, is the revenue generated from the other segments of lending and financial services, less the loan platform business. And then you divide this by the total number of products, and what you get is the revenue per product from lending and financial services, excluding the loan platform business. And so where this actually requires an additional layer of assumption, it's because we don't exactly know how many of these products on SOFI's platform have been attributed to the loan platform business, right? So when we actually remove the loan platform business revenue without removing the products that has been attributed to the loan platform business, the number that we get at the end of revenue per product in terms of lending and financial services, excluding the loan platform business, will end up on a slightly more conservative side, right? Because you're just taking a smaller revenue number, dividing it by the same number of products. And so to me personally, I guess this is okay because I'm cognizant of it and I want to be a bit more conservative in my valuations. However, if you're actually modeling out SOFI's business and you want an accurate way to track the business, then you have to discount the growth of products per member due to separating the loan platform business, and this adds in another layer of assumptions. Therefore, if you just take a look at the numbers with me, the lending and financial services products revenue, excluding the loan platform business, on a conservative side, comes in at around $40 to $41 of revenue per product, and that is what we're expecting for the rest of 2025. Now, moving into 2026, we will expect this to just increase slightly, perhaps to $42 of revenue per product, because as SOFI expands to serve more and more members, some of these members may not be in the same salary bracket and credit box as their current member base, right? So the revenue generated from these new members may keep the growth in this area of revenue per product slightly muted as they expand their member base. But if you take a look with me at the assumptions around the loan platform business, there are basically three main assumptions that we are making. One is about the structure of the Fortress deal. The second one is regarding the take rate of the loan platform business, and the third one is regarding the total originations from their other partners as a percentage of total loan origination volume from the loan platform business. So if you take a look over here, what we are assuming is that in the second quarter of 2025, we are going to see the last quarter of originations from the initial $2 billion Fortress deal that SOFI signed with Fortress back in 2024. Now, they have told us that the deal that they signed in April is an extension of this current deal, which means I only expect the origination of this second deal to start in Q3 of 2025, and that is what you're seeing over here. Now, going into 2026, my assumption is that because this second deal with Fortress will run out in Q2 of 2026, that this deal is going to be extended for a third term, right? So this means this will see us all the way into 2027, and then this is basically the loan origination volume that we are expecting in 2026 that is highlighted in the blue boxes over here. Now, the second assumption has to do with the take rate. Now, I know in Q1 of 2025, we have seen the take rate for the loan platform business go as high as 4.7%, but Chris Lapointe has been quoted on the earnings call as saying that, as they expand their loan platform business to serve people of lower credit ratings, perhaps this take rate will actually start to fluctuate, and so that's why I feel comfortable keeping it at 4.2% across 2025 as well as 2026. Now, I think another important aspect of the loan platform business is the originations of other partners that are not major deals like the Blue Hour Capital and Fortress of the world. And so currently this stands at around 29% of total loan platform originations, and I hope to see this number go up to around 40%, and I think that will be a slightly more healthy mix in terms of their clientele. And so with everything we have discussed so far, with just the revenue from the lending and financial services, including the loan platform business, in 2025, this gets you to $3.2 billion in terms of revenue for lending and financial services plus the loan platform business, which is just below their high-end guidance of $3.31 billion. Now, in 2026, this same approach gets you to around $4.4 billion, and honestly, this isn't too far-fetched. I know this number sounds quite big, but this actually represents a 38% year-over-year growth, and in Q1 of 2025, we are already seeing revenue growth go back up to around 32 to 33%, and I think we need to remind ourselves that just over a year ago, in 2023, that was not too long ago, SOFI was a company growing above 30% annually. And then finally, we actually get some clarity around SOFI's tech platform. Now, I'm not going to go into too much detail, but Anthony Noto, during that conference at JP Morgan, he actually told us to expect, tech platform revenue to reaccelerate in Q1 of 2026. Now, personally, when he says this, I'm actually expecting the reacceleration to occur at a pretty quick pace, considering that, in 2025, if the tech platform revenue is going to be flat, then they're going to have pretty weak comps, right? If we don't see at least a 17, even 20% year-over-year acceleration, then this is something that will start to make me a little bit concerned about the future of the tech platform. And to me, their performance in this tech platform business will affect how the market actually perceives them. Now, I understand the argument that, SOFI is actually generating more fee-based revenue through the loan platform business, but I don't think it can fully replace the quality of the revenue that the tech platform brings. Because while it is true, right, the fee-based revenue that they are generating from the financial services aspect of their business through the loan platform business does not take on any additional risk on their balance sheet. But we also have to recognize that this fee-based revenue is still, in a sense, a semi-risky revenue source. I mean, you can just ask Upstart, right? The loan platform business at SOFI is Upstart's entire business model, and it didn't prevent them from doing poorly in a bad macro environment because lending partners dried up. And so to me, that is the key difference between a fintech multiple as well as a tech multiple. Now, why SOFI deserves a fintech multiple, I think to me that is quite clear. They're growing faster than the legacy financial institutions and they are taking market share. But they will only deserve a tech multiple if they're able to prove that they can generate sticky and recurring subscription revenue from Galileo and Technisys. Because if you think about it, in a weaker macro environment, banks and financial institutions may slow down the pace of lending, but they're unlikely to move off their entire banking core. And that is why I tend to disagree that just because SOFI is generating fee-based revenue, all is well. Because to me, the quality of a fee-based revenue that is rooted in credit markets is still a different quality from revenue that is generated from a recurring subscription based on their tech platform services. And therefore, if you assume a mid to high single-digit growth in terms of tech platform accounts and the average tech platform revenue per account to come in at around 63 cents, then in Q4 of 2025, you will end the year with $115 million in tech platform revenue, which will represent an 11% year-over-year growth. Now, from there, if you take the average of SOFI's corporate revenue throughout the last couple of quarters and you project that out for 2025, what you end up with is a full year revenue for SOFI of $3.55 billion. Now, if you consider the fact that SOFI's current projection is $3.31 billion on the high end, assuming that they keep, raising and beating and raising in Q2 and Q3, then this would end up to be somewhere of a 4 to 6% beat on annual revenue, where if you look at the trend, it really doesn't seem too far off. And in 2026, a natural progression would be for the tech platform accounts to be growing at a pace of 20% year over year. Now, I'm not actually pulling this number out of thin air, okay? Because even growing at single digits for the whole year of 2025, SOFI should end the year with around 180 to 182 million tech platform accounts by the end of 2025, increasing somewhere between 6 to 8 million accounts every single quarter. And if you assume that between Q4 of 2025 and Q1 of 2026, there's only an 8 million increase in accounts, then for the tech platform accounts to come in at 190 million accounts in Q1 2026, that would actually represent a 20% year-over-year growth. And from here, if you take these projections for the full year of 2026 and do the same thing with their corporate revenue and average it out over the last couple of quarters, you get a full year revenue of 2026 to come in at around $4.8 billion. Now, before we even touch on the profitability metrics and valuation, I just want to point out that, earlier on this year, I was actually actually talking about the valuations of SOFI compared to some of the other companies in the fintech space. And because of the higher valuations, I said that, if we see any sort of market volatility or turbulence, we should see these companies fall at a faster pace than SOFI. And with Trump and his tariffs, that is exactly what we got. Now, apart from Robinhood, who has been executing at such a high level, other companies have actually fallen a lot more than SOFI on a year-to-date basis. Because I know that there's a lot of frustration at the moment directed at SOFI, but if you take a step back and look at things in perspective, it's really not that bad. I mean, definitely, right, you're not Robinhood, but it could be worse. You could be Upstart or even Block if you take a look at these numbers. So if we put all of these things together, you will end up with an adjusted net revenue of $3.5 billion in 2025 and $4.8 billion in 2026. Now, this would actually represent a 36% year-over-year growth in 2025 and a 37% year-over-year growth in 2026. Now, we have previously mentioned that this really isn't out of the realm of possibility, because if you just look back at 2023, this was the pace that they were growing at back then. Now, here is where it really gets interesting. Do you remember the incremental margins that we were talking about at the start of the video? Now, if SOFI was operating at just a 11% net income margin in 2025 and an 18% net income margin in 2026, the EPS in 2025 would be around 31 cents versus the 32 cents that was projected using their incremental margins. And SOFI's EPS in 2026 would come in at 66 cents, which is right on point with what we got with the incremental margin projections. And so at this point, I also want to note that, currently SOFI is trading at 32 times PE, and if you consider that their trailing 12 months earnings per share comes in at around 15 cents, if they manage to achieve just 31 cents of EPS in 2025, that would represent a 106% year-over-year growth on an EPS basis, which makes them valued at a 0.3 PEG today. Now, if we are looking purely right at the PE ratio, even with all the uncertainty around SOFI at the moment, they're still trading at 32 times PE. Now, I don't think it's too far-fetched to think that once we get a little bit more clarity in the macro, that they could go back trading closer to 40 times PE as they have done in the past. And I think this is a big difference in my assumptions that I've done previously, because if you have been following this series of valuations that I've done over the last couple of months, I think what you will have noticed is that previously, at the end of 2024, I used a sector average of 50 times PE. However, that was during the bull market, and we are in more uncertain times now, so I don't expect the PE ratio to actually extend past 40, right? So if using a 40 times PE, that would put SOFI's 2025 price to come in at around $15.53 and 2026 price to come in at around $26.25. Now, before you jump on me and say I'm too bearish, wait, relax, okay? I'm going to take this a step further and use their price to sales ratio, because like I said, SOFI has just turned profitable in the past year, so the PE ratio really isn't the best representation for this company, especially if they're going to be focusing on growth, which is why initially when I was using the PEG ratio, they came in at 0.3 PEG. And so what we can see currently is that SOFI is trading at a 5 times price to sales, while Robinhood is trading at a 17 times price to sales. Now, the midpoint here would be to use an 11 times price to sales, but if you take a 15 to 20% margin of safety and use a 9 times price to sales, then SOFI's 2025 price target would come in at around $25.41, and its 2026 price target would come in at around $32.81. Therefore, what I'm going to be doing is to take the average over here in terms of the pricing using the PE ratio as well as the price to sales to give you SOFI's end of year price target for 2025 to come in at around $20.47, and this will jump up to $29.53 in 2026. However, this really isn't the end of the story because of what Anthony Noto has said during his JP Morgan conference, and to see how his vision for SOFI will play out and how that actually affects SOFI's valuation in the year ahead, you really need to pay attention to my next video, and I'll see you in the next one.